All right, everyone. Bismillahirrahmanirrahim. Assalamu alaikum, everyone. My name is Yasir Yamin, and I welcome you all in this session. Now, in this session, we are going to practice on spreadsheet, on rather Microsoft Excel. One final accounts question. It's a more recent question to practice on. And so we need to make sure that we have good hands-on practice on Excel as well. Now, what I would recommend you while you are doing final accounts or consolidation questions is that you do a bit of questions on your Microsoft Excel so that you are well versed on how to work on the Microsoft Excel. And once you are done with it, you should practice each and every question, even if it's a it's a question from your notes, or if it's a question from your examination kit. Always go and try to practice on ACCA CBE practice platform. You can select a blank workspace and then work on the blank workspace. You need to get very good grip on the practice platform because that is a real life practice platform that you can really work on. All right. So please make sure that you be very well versed with the software itself. All right. So now we are going to do a question which is by the name of Sphinx Company, right? Your examiner says the following trial balance was extracted from the accounting records of Sphinx Company as at 31st December 20x5. Now, whenever you are in a question, you always note down, you always give importance to your accounting year end. So if I were you, what I would be doing is just go onto my spreadsheet and write down the year end somewhere so that I remember the year end very specifically. 31st December X5. Now, always remember that one of the more smarter moves in your examination questions is that you try and make a short summary of whatever data you find useful in the question. It will save you a lot of time on your actual application of the answer, right? So the trial balance as at 31st December X5 is as follows. Now, in the trial balance, first of all, you have been given land and buildings with a total value of 200,000. Now, out of this 200,000, it is clearly mentioned that land is with the value of 50 million. So that means the buildings cost would be the remaining 150 million or 150,000 if you're thinking about it in thousands. Then moving on, you have plant and equipment, which has a cumulative cost of 320,000. Then your examiner has provided you some accumulated depreciation, which is at the start of the year, which is 1st January X5. Buildings have an accumulated depreciation of 90,000 till now, whereas plant and equipment has an accumulated depreciation of 111,200. All right. This is fairly obvious that land is not, it's not depreciated. That is why you have only been given the building's accumulated depreciation of 90,000. That's the, understanding part of it. Then moving on, you have been given inventory at 31st of December 20x5. So in closing inventory is 115,000. Then you have trade and other receivables pre-prepared 130,000. Then trade and other payables 70,500. But your examiner has highlighted this fact that you would need to refer a particular note in this, and that is note number 2. Now, whenever you are in an exam, always make sure that you take good note of the fact that some notes are connected to a particular line item in the trial balance. That's the only way that you'll make sure that all adjustments have been made for, right? Moving on, you have a bank OD. You see, it's on the credit side of the trial balance. That means it is bank OD of 16 million, 16.2 million or 16,200. Then you have a current tax payable of 2,500. Can anybody of you please quickly highlight that what does this 2,500 of current tax shown on the debit side represents? What is this? I'll give you full marks for it if you just let me identify that what does this 2,500 actually represent. Anyone? You see, the confusing part for me is that tax is a payable, tax is a liability. But still this tax payable or tax liability is shown on the debit side of the trial balance. Now, logically, tax payable should be shown on the credit side because it is a liability, but it is shown on the debit side of the trial balance. Even though your examiner has highlighted that you can see note number 4 for this, but believe you me, we have already discussed this in our IS 12 lecture. What is this debit side current tax? For sure, there is no doubt about this. This 2500 would have represented the under provisioning of current taxes of last year. Very good, Sarthak. This is under provision. Excellent, excellent. Remember, we learned this way in our classes that we do not rely on examiner comments. Rather, in the FR paper, we should be well versed, we should be well prepared so that we can take on such questions on our own. We don't need examiner's note, right? So that is the way to go about it. Then you have been given 7% 20x9 loan notes of 30,000. Yeah, so these are loan notes. Then you have been given share capital of 120,000, whereas the par value is $1. The par value is $1. Then you have been given share premium. If you look closely, both share capital and share premium have been given the note reference of note number 5. Yeah, so there is something in note number 5 that we need to go and check out and do adjustments in our trial balance. Then you have been given opening retained earnings. See, 1st January X5 means opening retained earnings. You have been given opening retained earnings of 158,150. Most likely this balance would be useful for you when you prepare your statement of changes in equity, if it's so required in your examination. Then you have been pre-prepared given a draft 20x5 profit before taxation of 166,450. And here comes the question in my mind when I'm reading such sort of a question in an examination. If my examiner has already calculated a profit before tax, what do I have to do in this? What is my role? So if you go and look at the requirements, please go and look at the requirements. Yeah. So basically, there are 3 requirements. For the first 4 marks, you need to prepare a schedule of adjusted profit. You do not need to prepare the whole statement of profit or loss or OCI. But rather in this question, your examiner wants you to just prepare a schedule of adjustment. So you have already been given a draft profit. Draft profit means not a final profit of 166,450. You need to look at the adjustments that have been discussed here on. And then you need to make adjustments to the draft profit to arrive at the final profit. And this is just for 4 marks. So pretty less adjustments here. Yeah. Then once you are done with this, you will go on for 6 marks of the requirement, and which is to prepare a statement of changes in equity. If you remember it correctly, statement of changes in equity was prepared as you took the opening, made the year on adjustments, and then arrived at the closing figure. And once you are done with this, you have got a 10-mark requirement in which you need to prepare the statement of financial position. I believe that we will be, in a much better position to do once we have already done all the adjustments. Yep. So with this, now we can start with the adjustments in particular. I would need your utmost participation and utmost attendance here. You need to have your calculators within yourselves, within your hand, and just let me know the answers whenever I require. Although I have an Excel in front of me, so it's very much convenient to calculate some things, but still I want you to be responsive enough. Yeah. So there is note number 1. It says that until 1st January X5. What do you mean by 1st January X5? Now, 1st January X5 means that we are discussing about the year start. Yeah. So until 1st January X5, Sphinx Company held land and buildings at cost. So before the start of this particular year, we have always maintained the historical cost of our land and buildings. But on 1st January X5, Sphinx Company had them valued at 250 million. The land and buildings were both valued at 250 million, of which $80 million or 80,000 related to land. And believe you me, your examiner says that no entries have yet been incorporated to incorporate this valuation. No entries have been made yet. And the buildings have a remaining useful life of 20 years as at that date. Now, what is going on here? What I would do is I would just go on my spreadsheet above, write working number 1. I will just bold it. Why am I bolding it? So that it clearly represents a particular heading to my examiner. Done. Now we have two things in question. Number 1, we have land, and the other one, we have buildings. Yeah. What you can easily do is right click, middle align, and then you can have a total here as well. I'm just trying to teach you some sort of Excel. Yeah. So here is a position which aligns your words in a particular cell. If you click this, it will center out your word. So it looks more cleaner to your examiner. And again, since this is a heading, I will just bold it Control B. Or rather, you have this option in your examination as well as in your Excel. Just click this and you will have a bold of whatever you want. Yeah. So first of all, if we look at the land and buildings, we have already been given the cost of these land and buildings. So the total value of land and buildings was 200,000 and the land's cost was 50,000. So I can just write 50,000 of land, whereas 150,000 of building, and that would have made a total of 200,000. How do you total? Put n is equals to, select the first cell, put a plus sign, select the second cell and enter. Here you have it, 200,000 of total cost. Yeah. And then you minus any accumulated depreciation till 1st January X5. Now you can see that the word that I put up in cell, it's overriding this cell and going into the next column. What you can easily do is go onto your spreadsheet, make sure that you take your mouse cursor towards the top, and here you can see the cursor turns on black. With a dragging sign, it turns on black. Just click on it and drag on it towards the right, and there you have it. You have adjusted your column width. Yeah. Now these are the very basics that I want you to understand, because this will make your life much easier. When it looks good, you feel good. Yeah. So accumulated depreciation is 90, obviously it's nothing for land, but for building, it's already been given as at the start of the year of 90,000. So 90,000 is a negative. So I will put is equals to minus 90,000, right? Is equals to minus 90,000. And you can always change the look and feel of this. You can always put a bracket. How? I'm just going to right click and you have this comma sign in front of you. Yeah. You just select this and it will turn it into an accounting style. It will turn it to an accounting style. You have here the increase and decrease of decimal places option. If you put, if you select the left sign, it will increase the decimal places like this. Or if you just select the right hand side, the right side of the decimal place, it will just close on the decimal places. It is just for you to have an understanding of how spreadsheets actually work. Yeah. And here you have it, you will have the carrying value. So land has a carrying value of, equivalent to its cost, whereas the building will have, oh my God, the building will have a carrying value of 60,000. And so that this becomes a total of 110,000. So what I'm trying to just, make clear in your mind is that I can just write it down as well. At 1st January X5, you have a carrying value in your books of 110,000 for land and buildings. But at the same date, if you just go and look into the question, you have revalued your buildings and land up to a value of 250,000, of which 80,000 relates to land. So what do? You say revalued to. You say revalued to. Your land has been revalued to 80,000. Whereas, your building would have been revalued to. Any guess? How do we calculate how to what level my building has been revalued to? You see the total value was 250,000. So I would write 250,000. Yeah. And subtracting what was related to land. Yeah. Minus sign and just select land's value. And here you have it, the building's value would be 170,000. So the total value of land and buildings, the revalued amount is 250,000. And often students comment, sir, it is very difficult for us to understand that how many zeros have we written. Yeah. So the easier thing is that you always select the cells that you want to work on. And you have a comma, the accounting comma style here. Just select this and close the decimal places, and here you have it very easily understood. 80,000, 170,000, 250,000. It's very much apparent for you. And you are going to do the same thing in your examinations. It will make sure that you don't, put on extra zeros in your examination and, just mess up your question. Yeah, it will give you a lot of confidence. Now, your assets have been revalued to a particular level, and this brings the facts that your assets have been revalued by a certain amount. What amount? Previously your land was 50,000. Now it has been revalued to 80,000. So that means if you take difference of these both figures, you will get 30,000 as your revaluation amount on land. Your building has been revalued to 170,000 rather. And you put up a minus sign and take the difference from the from the carrying value, which is 60,000. How do I go on it? Just move your arrow keys, and here you have it. Just go on 60,000, press and enter, and here you have it, 110,000. You can even just copy this formula. I'm just doing Control C on this cell, going on to the cell which is besides it, Control V for pasting, Control V for violin, and you see your spreadsheet is smart enough. It will just copy this formula onto this cell as well. Yeah. So you can see 250,000 and 110,000. The total evaluation has been 140,000. Yeah. So now your asset has been revalued by 140,000. Any idea what should be the accounting entry? Please just let me know what should be the accounting entry that we should be making here. What debit and what credit? Land will be debited, or DR, by 30,000. Yeah. Buildings will be debited by 110,000. And here on you will have a revaluation reserve, or an OCI. We are not required to prepare an OCI in this question. So I can just put revaluation reserve here. Revaluation reserve credit by the sum of these two. So debits and credits match. Now, in an examination question, are you required to prepare such sort of an entry? No. Will you get marks for it? No. Will the examiner deduct marks for it? No. But why do I prefer making entries? This is just due to the fact that it makes your life much easier. Students are very, very well versed with the concepts of double entry. And we always used to practice the same while we were doing questions in our classes. So it's much convenient for you if you make an accounting entry just for the sake of clarity. Yeah. And now we are done with it. Now your buildings and land have been revalued to a certain amount. But your examiner, if I remember it correctly, your examiner also said that the buildings have a remaining useful life of 20 years at 1st January 20x5. Now, I ask each and every one of you a particular question. Why your examiner has given you a remaining useful life here? Why? Kyun? Why? Why your examiner has given you remaining useful life here? To calculate depreciation. Excellent. Your examiner wants to do calculate depreciation. This is fairly obvious. Now we are going to calculate revised depreciation. And when we calculate revised depreciation, you might you might remember the formula that we used to follow. Revised net book value minus revised scrap value. Yeah. And then we used to divide it by, oh my God. And then we used to divide it by the remaining useful life. Remember? That was the formula. Once you have done your evaluation, you have updated your net book values. If you have updated your net book values, you need to calculate revised depreciation based on your remaining useful life. So your building's new value is 170,000. There is no scrap value given in the question. Your building's new value is 170,000. I can just go and select it from my spreadsheet. Now, always remember, fellows, that it is a wise option that you link your workings. It is a wise option that you always link your workings. It helps your examiner to assess that how you have done this calculation. Now, one thing could have been that you have just put in this cell 170,000 manually. What otherwise you can do is, you can just put is equals to, move on your arrow keys, go to the building's revalued amount. It looks very much exciting to your examiner, and then divided by the remaining useful life, which is 20. And here you will get it. You will get your revised depreciation on building for the year. Now remember, guys, this revised depreciation on buildings is an expense. While we are making our schedule of adjustments, this will be reported as an expense in our books. This will be reported as an expense in our books. So it will reduce our profit. It will reduce our profit. Done? Clear? Then we move on. Your examiner says defer tax on the revaluation is calculated at 20%. Furthermore, your examiner has just told you that defer tax on revaluation also has to be incorporated in this. And it says that defer tax on the revaluation shall be calculated at the rate of 20%. Can we do this? I mean, why not? There is nothing in this world that we can't do. So we just write, defer tax on revaluation. And I would want you to prepare an accounting entry for this. So just make sure that you write the accounting entry for this ASAP. Defer tax on revaluation. The whole revaluation has been for 140,000. You see, when you revalue your assets, your carrying value in your books would have increased. But tax people, they do not know about, IAS 16's revaluation model. So they don't revalue their assets. We revalue our assets. They don't revalue their assets. That means there is a temporary difference between both our values. And if there is a temporary difference between both our values, our carrying value would be higher. Our carrying value would be higher. Their tax base would be lower. And thereon, we would have got a taxable temporary difference. I can do it for you, guys. Defer tax on revaluation. I'll just make 3 columns. One column for carrying value. The other column will be for tax base. And the difference of these both is known as the temporary difference. Yeah. I'll just middle align this so that it looks more, appealing to you guys. Now, carrying value. As a result of revaluation, our carrying value have been increased by 140,000. Yeah. But the tax base would not have increased due to any revaluation, because tax people do not know about revaluation. Hence, there would have been a difference between our carrying value and tax base. Remember, our carrying value is higher, tax base is lower, and that means there is a taxable temporary difference. And everybody in this world knows that whenever you have a taxable temporary difference, you always get a deferred tax liability. How do you calculate the deferred tax liability, my friends? How do you calculate that? You put on the tax rate here. So 140,000 of difference multiplied by, you get this sign shift 8. Multiply it by the tax rate, and there you have it, a deferred tax liability of 28,000. Now, I will give again full marks to any of you guys if anyone can tell me what should be the accounting entry for this. 28,000 deferred tax liability. And I always say that start with the easier thing. Make an accounting entry, but use your common sense and start with the easier thing. And I want everybody to answer. Everybody, please. Just let me know how to make an accounting entry for this. It's very easy, by the way. Very easy. Okay. So somebody says that's a 28,000 debit. That was very common sense. Something would be debited by 28,000 and something would be credited by 28,000. The easier thing to go about it is it is a deferred tax liability. So definitely there is going to be a deferred tax liability credit of 28,000. Now the question goes is that what do you debit? What do you debit? And somebody says that, sir, Tanzila says that, sir, P&L debit. And that's the thing that you are incorrect about. There will be no P&L debit. Remember, tax of transactions are accounted for in the same manner as those transactions are accounted for. So if this revaluation of 140,000 goes into revaluation reserve, then the tax impact of this revaluation also goes into the revaluation reserve. Remember? You remember? So the accounting entry would be revaluation reserve debit 28,000. Right? And this is why I always, push you guys to make accounting entries, because it helps you a lot memorizing your concepts, revising your concepts. And, there are very less chances when you make an accounting entry correctly that you make a mistake. Yeah. So nothing goes into P&L here. Please remember, nothing goes into P&L here. I'm just going to highlight it by another color for you guys so that you remember it correctly. Nothing goes to P&L here. But yes, regarding balance sheets and regarding your statement of changes in equity, this is relevant. Yep. Let's move on. Your examiner says that Sphinx Company has a policy to make an annual reserve transfer in respect of the additional depreciation charged each year. Prior to the revaluation, the buildings were depreciated over 50 years on a straight line basis. Now, what is this whole paragraph all about? You see, we studied in IAS 16 that there is a potential policy for a company to adopt, that they can make a transfer from their revaluation reserve into retained earnings on a per annum basis. On a per annum basis. And that concept was known as the concept of excess depreciation. The entity can opt for a transfer from revaluation reserve to retained earnings on a per annum basis. On a per annum basis. And that is what is happening in this question. So what we are basically doing is realization of revaluation reserve. Realization of revaluation reserve. So we have two options in front of us. Either we make a transfer of revaluation reserve to retain earnings at the end of useful life when your asset is ultimately sold. Or the other thing could be that you can make a transfer to revaluation from revaluation reserve to retain earning on an per annum basis. And we are following per annum basis. How do you do that? You select your revaluation reserve and just I'm going to make a bottom underline. How do you do that? You have this area. In your Excel, you have this area. You go here, select the bottom border, and here you have made a line. Your examiner can clearly see what you are actually trying to represent. So revaluation reserve divided by remaining useful life. This is the format for it. Yeah. So my revaluation reserve is going to be not 140,000, but I'll take 110 maybe. I'll take 110 maybe. Why? You see, land basically has, land basically has indefinite life. Yeah. So I'm not selecting land here, just going to select the building's value. And what is my, if I make a bottom border again, what is my remaining useful life? If anybody remembers, my remaining useful life, my examiner said what's 20. Yep. So revaluation reserve divided by remaining useful life. Revaluation reserve divided by remaining useful life. And that would be 120,000 divided by 20. That is 5,500. Now, again, I'll give full marks if anybody tells me the accounting entry for this 5,500. What is the accounting entry? I want to know this accounting entry of this realization of revaluation reserve from everyone. And it's a very easy accounting entry again. Very easy accounting entry again. I can assure you of this. So in this case, you are actually, selecting some sort of money from your revaluation reserve and transferring it into retained earning. You are selecting money from your revaluation reserve and transferring it to retained earnings. How do you do that? You will make a debit to revaluation reserve by this amount, 5,500. And thereon, you will credit retained earnings by 5,500. This is the accounting entry that you prepare for it. Excellent. Excellent. Very good. Done. And again, this has nothing to do with your P&L adjustments. Please, this is just a reclassification of equity reserves. And since this is just a reclassification of equity reserves, make sure that you understand this pretty carefully, that all of this is only relevant to statement of changes in equity. This is just a reclassification of your equity reserves. Nothing of this is related to your profit or loss account. Done. So now we have done a very big adjustment. Almost we have done it a very big adjustment till here. But there is one another line. It says that depreciation on plant and equipment is calculated using 15% per annum using reducing balance method. We haven't calculated depreciation on plant and equipment yet. Yeah. I don't think this is the more difficult part here. Just calculating depreciation expense. Any idea how to calculate it? On reducing balance basis. So reducing balance basis means you apply your depreciation on your net book value. And how do you calculate your net book value? Cost minus accumulated depreciation. So if you go above, you have a cost of 320,000 of plant and equipment, and you have an accumulated depreciation of 111,200. So I'm just going to write it down, 320,000 minus 111,200. Here you can see the numbers being put up. Yeah. Bracket close. Yeah. Bracket close. And then once you have got the net book values, you will just multiply, shift 8, get this sign, multiply. And then you will multiply it by 15%. So 15%. You get shift and 5. You get up the percentage sign. Shift and 5. It's already written on your keyboard. Yeah. So it is 31320. This is your depreciation expense. And remember, this depreciation expense is related to your P&L. So I'm just going to give it a color code for you guys. There is no need to do this in your exam. But remember, this is an expense which will go into the schedule of adjustments on profit or loss. Done. Now, I want everybody to give me a confirmation that you understand all the workings that we have done up till now, and then we'll move on. Just give me an okay. Perfect. Excellent. Very good. So working number 3. Yeah. Now working number 3 is related to my friends note number 2, and this might be a bit new for you. So please make sure that you understand very clearly what I'm trying to say. You see, on 31st of October 20x5, 31st of October 20x5 means you have an year end, you have a year end of 31st December x5, and they are talking about 31st October x5, right? So it's before the year end that they are talking about. At 31st October x5, Sphinx Company acquired inventory from an overseas supplier on credit for 40 million dinars. For 40 million dinars. Now remember, guys, you have bought an inventory. You have bought an inventory from a foreign supplier for 40 million dinars. Yeah. So it's basically an import. Nothing rocket science in it. You have just basically imported some raw material from an overseas country. Now, whenever you are faced with a foreign currency transaction, and you will study about this when you study IAS 21, I'm not very sure that you have done it till now or not. But still, in IAS 21, you need to convert your foreign currency transactions into your functional currency as soon as it is required. As soon as it is required. And the correct format to do that is that you make 3 columns. You make 3 columns always. Make 1 column for foreign currency. And I'll just drag and expand this column a bit. Then make 1 column for exchange rate. Then make 1 more column for local currency. All right. So the format that you will have to follow is that you make 3 columns. Done? Then just try and follow what I'm going to tell you. You see, what happened was that on 31st October X5, you purchased some inventory for 40 million dinars on credit. On credit. So 40 million dinars means a foreign currency of 40,000. This is 40 million dinars. Yeah, this is 40 million dinars. But you see, you have a functional currency. You have a functional currency of, you have a local currency of dollars. Yeah. Now, if you bought something in dinars and you prepare your financial statements in the local currency of dollars, you cannot make an accounting entry, inventory debit, accounts payable credit in dinars in the books of accounts that you prepare in dollars. Make sense? Do you understand what I'm trying to say? You prepare your financial statements in dollars and you have just bought an inventory, you have just bought some credit inventory in dinars. Now you need to prepare an accounting entry for this transaction, but since you make your financial statements in dollars, you need to report the transactions in dollars. So you'll have to translate, you will have to convert this 40,000 dinars into dollars. And how will you do that? How will you convert dinars into dollars? By using an exchange rate. By using an exchange rate, very easy. So if you go down in your notes, it is written that the following exchange rates are relevant. Now we are at 31st October 20x5. We are at 31st of October 20x5. And at that date, $1 was equal to 4 dinars. $1 was equal to 4 dinars. So you have an exchange rate of 4. You have an exchange rate of 4. Now I need to calculate dollars here. Now I need to calculate dollars here, and here is a test for your mental maths and common sense again. A bit of financial management too, but I believe it's more of common sense. I have an exchange rate of $1 is equals to 4 dinars. Yeah. I need to convert dinars into dollars. What do I do? Do I multiply these dinars with 4 or do I divide these dinars with 4? Do I multiply or do I divide? Just give me your version. And I'll do voting between the class. Do I multiply or do I divide? What's the correct approach? I need to convert 40,000 dinars. Consider yourself having in your pocket 40,000 dinars and you need to convert it into your local currency, be it PKR, INR, whatever. How do you do that? Multiply or divide? So there are mixed reviews about it. Some say multiply, some say divide. But I say, you see, there is something that you study in the paper of financial management F9. You study about direct quotes and indirect quotes, but that is something that we discuss in F9. But even if you haven't studied F9, can't you use your common sense? You see, $1 is equals to 4 dinar means that each dollar is equal to 4 dinar. Use your common sense. Dinars are 4, dollars are 1. Dinar is higher and dollars are lower. Dinars are higher and dollars are lower. So technically, from a higher value, you need to go to a lower value. $1 is equals to 4 dinar. Use common sense, use mental maths. Dinars are higher, 4 dinars. Dollars are less, $1. So you need to go from a higher value to a lower value. And if you want to go from a higher value to a lower value, what do? Do you multiply to go to a lower value or do you divide to go to a lower value? What do you do? Common sense. If 40,000 are dinars, dollar will be less. And if I want less dollars, do I divide or multiply? Oh, Ahmed, you use your common sense. I have 40,000 dinars and I want to go to a lower dollar value. To a lower dollar value. You meant simple mathematics. I have 40,000 dinars and I want to go to a lower dollar value. If I multiply, then the value would be higher. See, 40,000 dinars is equals to $160,000. 160, the value gets higher. This is wrong. You have something more in dinars and the dollar value will be less. So you need to divide. I say use your common sense. Do not worry about direct quote and indirect quotes. Just use your common sense. And simple mathematics, even if you don't have financial management knowledge, simple common sense will help you here. And this is the right way to do it, by the way. Because in your exam, you might get confused, sir, multiply, sir, divide, sir, multiply, sir, divide. Why do we even think like that? Use your common sense and then you'll always do it correct. Yeah. So, आगे जी, where here we have it $10,000. And what should be the accounting entry on 31st October X5? What should be the accounting entry? Inventory debit 10,000. You make the entry by always your local currency. And here you have it, payables credit $10,000. Yep. So you have made this accounting entry correctly. Now, let's move on. Once we have made this accounting entry, let's move on. And what do I really want to tell you here? You see, it says that the invoice was paid in full on 25th of January 20x6. You see, the point I'm trying to make is you bought some inventory on credit on 31st of October X5. But you are paying for this inventory on 25th of January next year. You are paying for this inventory on 25th of January next year. If you haven't paid your liability by the accounting year end, please focus, huh? You bought something on credit and as a result of which you have your payables in your book of $10,000. Yeah. And you settle this liability next year. If you settle this liability next year, then that means that you still have the liability in your books of accounts as at 31st December X5, which is supposed to be our year end. Do you agree or not? We still have the liability in our books of accounts as at 31st December X5. Now, fellows, as per IAS 21, and you will study that when you study IAS 21 if you haven't done it till now. As per IAS 21, if any company has a monetary asset or a monetary liability means any liability which is to be paid in cash. So if you have a liability, a foreign currency liability in your books of accounts, then you need to retranslate that liability on each reporting date based on the closing date exchange rate. Sir, what are you saying? You see, this liability of 40,000 dinars is still outstanding on 31st December X5 because this has been paid on 25th of January next year. So this liability was outstanding by the year end. And if 40,000 dinars worth of liability is still outstanding on your supplier on your side, then as per IAS 21, if you have a foreign currency liability in your books of accounts, you must retranslate, you must reconvert that liability based on the closing date exchange rate to assess if the exchange rate movement has gone in favor or against you. Has gone in favor or against you. You just see, by the year end, the exchange rate has gone $1 is equals to 5 dinars. You see, everybody knows that exchange rates do not remain constant. So when we took on this liability, the exchange rate was 4 and now it is 5. And again, do we multiply or divide? Ahmed, do we multiply or divide? What do? We divide. So the same liability on the previous exchange rate, it used to be 10,000. And now based on the closing date exchange rate, since this liability has not yet been paid, the liability comes on to be $8,000 only. So what do you think? Is the exchange rate moving in our favor or against us? Let me know your feedback. Is the exchange rate moving in my favor or against me? Previously, when I took on this liability, I had a liability to pay $10,000. But now, when I revalue this liability by the accounting year end, I've still not paid my supplier. If I revalue this liability, my liability becomes only 8,000. So if I were to pay 40,000 dinars at the year end, my liability would only be in my local currency in $8,000. So it's my advantage. It's my benefit. Yeah, it's my benefit. So I have an exchange gain. I have an exchange gain of the difference. I have an exchange gain of 2000. Do you all agree? Please let me know. Do you all agree? I have an exchange gain of $2,000. You see, this happens with us every time now. When we start studying for our paper, we have a particular pound rate in our minds. Yeah. But by the time we go and pay our examination fee, the exchange rates gets to somewhere else. And unfortunately, we always have an exchange loss. I don't know why. But at this time, when you revalue your liability, you have an exchange gain of $2,000. And you know how IS 21 requires you to prepare an entry for it. It says that your liability has decreased by 2000. So you will debit your payable. You will debit your payable by 2000 and you will credit profit or loss. Yeah. So you will credit your P&L. So any exchange gain always go into your P&L. Please let me know if everybody understands the solution of this transaction. Now, this is an income. It will go in the schedule of adjustments. Done? Perfect. Excellent, guys. Very good. So now we are done with working number 3 as well. All right. So let's go for working number 4 now. Let's go for it. Now you have note number 3. And this is a very easy note. So you need to be very quick with it. Let's see how quick you are. It says that interest on the loan notes is paid every 6 months with the next payment due on 1st January X6. So please. You have a liability. You have a loan note of 30,000. Please look at this. You have a loan note of 30,000 and the exchange rate is 7%. Sorry, the interest rate is 7%. So you have a loan of 30,000 and you have an interest rate of 7%. Your examiner was saying that interest on the loan notes is paid every 6 months. We pay our interest every 6 months. So the next payment is technically due on 1st January X6, which is the first date next year. We have to pay our interest next year. If something, Tanzila, if something has to be paid next year, do we even care? Should we be even, be considerate about this? Should we care? I mean, we have 6 months of interest, which has to be paid next year. So why do we care? I mean, we should care. You know why? Because of accruals concept. Because of accruals concept. Now, accruals concept told us that a business should record its real expense or real incomes for the period, irrespective of the amount paid or received against it. We do not follow cash basis accounting in our books of accounts. We always follow accrual basis accounting in our books of accounts. And since we do not follow cash basis accounting, even though the payment is to be made next year, but that interest period relates to this year. If that interest period relates to this year, we need to recognize an accrued expense. Otherwise, it would be wrong. Don't you all agree? Please let me know. Don't you all agree? Even though the payment has to be paid next year, but the interest is always paid for a particular period of time, and that time is this year. It relates to this year, but it will be paid next year's first day. Yeah. So there should be an interest expense accrued form. It says the draft profit before taxation figure in the trial balance includes the first interest payment on the 7% loan made on 1st July X5. So your interests are paid, biannually. You have a $30,000 loan note, 7% rate of interest, but interest is paid 2 times in a year. So examiner says that your trial balance figure of profit or loss already contains the first interest payment. That means it does not contain the second interest payment, the half-year interest payment. And how do we calculate that? Interest accrued will be calculated as, you see, our liability, if you go up, your liability is $30,000. Your liability is $30,000. Understood? Your liability is $30,000. You multiply it by 7%. And here you can see in the bar what I'm doing. You multiply it by 7% and also multiply it by 6 by 12. Also multiply it by 6 by 12 because only 6 months of interest is due this year but will be paid next year. The rest, the first installment was already paid on 1st July X5. Yeah. So when you go and calculate this, the amount of interest accrued would be 1050. And the accounting entry for this would be interest expense debit 1050, whereas accrued interest credit by 1050. Just let me know, do you understand this? Do you guys understand this? Just let me know. Yes or no? Yeah. And I have highlighted this yellow just to remember that I need to take care of this when I'm making a schedule of adjustments of my P&L. Yeah. Everybody, all clear? Yeah. Let's move on. And now is working number 5. Working number 5. It says that a provision for income tax of 30,000 is required for the year ended 31st December X5. What is this? I'll give you full marks if you tell me what is this 30,000. What is this 30,000? Just let me know what is this 30,000. A provision for income tax of 30,000 is required for the year ending 31st of December X5. What is this? For this particular year, the tax provision should be 30,000. Excellent. Excellent. This is current year tax provision. Current year provision, 30,000. Done. Then, examiner says the balance on the current tax represents the under or over provision of tax for the year ending 31st December X4. The balance on the current tax represents under or over provision. Under or over provision. What do? We have an under provision in our trial balance and we already knew about it. If you go above, your trial balance has this current tax payable of 2,500 and this 2,500 is basically your under provision. Now, under provision always becomes an expense. Always becomes an expense. So for this year, you have a 30,000 expense. And for the last year, you have a 2,500 expense. What should be my total tax expense for P&L? It should be 30,000 plus 2,500. And here you have it. This is an expense. Does everybody understand this solution? Please let me know. Does everybody understand this solution? Just let me know. All done? Everybody clear? Excellent. Now we are down to the last adjustment and thereafter we are just free to move on and prepare our financial statements. That's the easier part always. So working number 6, my friends. So in working number 6, we have the note 5. It says that on 1st of September X5, which is 3 months, 3 or 4 other 4 months before the year end, on 1st September X5, Sphinx Company made a 1 for 5 right issue. So I'll just write it down. 1 for 5 right issue was made. right? And you remember the right issues entry, cash debit, share capital credit, and share premium credit, yeah? At $1.25 per share. So the company actually made $1.25 per share right issue. It says that the right issue was correctly accounted for on 1st September X5 and the shares are included in the trial balance. Now the right issue has already been accounted for. The right issue has already been accounted for. If it's already been accounted for, why should I worry? Why should I worry? Is there anything to do here? It has already been accounted for. It has already been accounted for. Why should I worry? Should I worry? There is a specific reason why I should be recalculating this number. Why? You see, during the year, you made a right issue. And that right issue, the impact of that right issue is already included in the trial balance above. It is already included in the trial balance above. Now we have a requirement in this question to prepare statement of changes in equity. And if you remember the format very correctly, the format for statement and changes in equity was that you started with the opening balance, made the during the year adjustments, and then arrived at the closing balance. You always had to start with the opening balance. But here, we don't have the opening balance of share capital and share premium. You know why? You know why? Because we have already adjusted the during the year right issue in this number. We don't have the opening balance because the right issue is already adjusted in these numbers. Don't you think? So we need to recalculate the opening balance just for the sake of our statement of changes in equity. And how do we do that? I'll tell you. You see, 1 for 5 right issue, 1 for 5 right issue means a right issue of 20%. Sir, how did you come up with this number of 20%? Where did this come from? 1 divided by 5. For every 5 shares, we have to issue 1 new share. So 1 divided by 5 is 0.2, or you have this percentage bar here, click on it and you'll have a percentage number, 20%. Yeah. So you need to understand that 1 for 5 right issue is basically 20% issue. First of all, just please everybody let me know. Do you understand this 20%? Where did this come from? Does everybody understand this 20%? All good? Done. Now, my fellows, if you understand this 20%, which is just 1 divided by 5 right issue policy, 20%. If you try and understand, just think of it as our opening balance of share capital or share premium would have been, 100%. Anything which is at the base level is 100%. But during the year, we would have made a right issue of 20%. And when a right issue had been correctly accounted for in our financial statements, our closing balance would have been 120%. Do you all agree? I want an answer from everyone. Do you all agree? My opening balance would have been 100%. And then there would have been a right issue of 20% during the year so that our closing balance becomes 120%. Do you all agree? I want an answer from everyone. Okay. So I can just reverse work it out, no? So I write the same thing. Opening, right issue, closing. My closing is equivalent to 120%. And what is my closing balance after incorporating the right issue? If you go up, your share capital is 120,000. Your share capital is 120,000. Do you all agree? 120,000. And that is 120%. That is 120%. So 120,000 is basically equal to 120%. If now I'm just putting up a formula. If this 120,000 is equivalent to 120%, then what would have been the opening balance which is equal to 100%? Basic common sense. If 120,000 is equal to 120%, then what would be 100%? So what I do is I divide 120 multiply by 100. I divide by 120 multiply by 100. Yeah. So the simple answer would have been, Sarthak, very good. You just said the opening balance would have been 100,000. The opening balance would have been 100,000. Now, please confirm it to me that does everybody understand this? Is everybody clear with this 100,000? Do you all agree? Do you all agree? I want an answer from everyone, please. Done. And that would mean that right issue during the year would have been 20,000. Do you all agree on this as well? The right issue would during the year would have been 20,000, which is the difference of these both. Huh? So basically, during the year, our share capital would have been credited by 20,000 due to the right issue. And you see, share capital is always recorded at par value. Share capital is always recorded at par value. Don't you know? So if I were to ask you that how many right shares were issued, how many right shares were issued? So you would say that due to the right issue, our share capital would have been credited. Our share capital would have been credited by 20,000. The par value was 1. So number of right shares would have been, how much? 20,000. Makes sense? So basically what happened, Ali, was there would have been a right issue of, I'm just writing the interpretation, right issue of 20,000 new shares, 20,000 new shares at price of, just go and look at the question, price of 1.25, right? This is basically the interpretation. And how much cash would you have generated? How much cash would you have generated? Anybody know? You would have made 20,000 right shares issue multiplied by 1.25 of cash, and that would have meant that you would have generated $25,000 worth of cash. 25,000 worth of cash would have been done. Share capital would have been credited by 20,000 and share premium would have been credited. Share premium would have been credited by 5,000. That would have been the accounting entry made during the year. Does everybody understand this? Please just let me know. Are you clear on this? Done? All okay? Excellent. Now, if I were to ask you, please let me know if I were to ask you that what is my opening share capital and what is my opening share premium? Can everybody confirm? And I want an answer from everyone. Please don't think as if few people answer, you don't need to answer. I want an answer from everyone. What is my opening share capital and opening share premium once you have understood this adjustment? The closing is given in front of you, 120,000 and 5,000. What would be my opening balance for share capital and share premium? I want an answer from everyone, please. Share capital 100,000, excellent. And what about the share premium? Share capital 100,000, excellent. Share premium 0, excellent. Excellent, guys. So share premium would have been 0 because the 5,000 this written here was just generated due to the right issue made during the year. Our opening balance would have been 0. Excellent. And now once we are done with all the adjustments, now we just need to go on and prepare these 3 requirements, schedule of adjustment, statement of change in equity, and SOFP. And believe you me, now it's not difficult. And I'll just show you how to do it. I'll just make up some room for me. Write down here requirement A, making up some room for me. And this requirement number A is basically the schedule of adjustments to profit or loss. Schedule of adjustments to profit or loss. Simple. And how do you do that? Does anybody know how do we do that? Yeah. How do we do that? You start up with your draft profit or loss. Draft profit or loss. So we have draft before tax. If you remember the question, we have draft profit before tax, which is given here. Just look at it. This is 166,450. 166,450. Here you go. Just converting the format a bit so that it's easier. And then you pass on adjustments. Then you pass on adjustments. Now remember, we had variety of adjustments within ourselves. Yeah, many adjustments we had. So the first adjustment would be obviously coming up from working number one. Let's go working one by one. So the first working expense adjustments that we had to do was the revised depreciation on building 8,500. So the first working, I would refer working number one, revised depreciation on buildings. Yep, this is it, right? Then look at it. Just go on and look at your workings. Just find out where you had some expense highlighted. Then we move on. Yes, working number two, plant and equipment depreciation expense. Again, I would just go on, refer to working number three, or maybe working number two. I don't remember what it was. Yeah, working number two, and that was depreciation on plant and equipment. Yeah. Just mention your workings. It will help you. It will help the examiner trace out from where you have brought the workings from. Then you have working number three, and here you have an exchange gain on payables. Yeah, an exchange gain on payables. So again, I'll just write it down for your examiner. Working number three, exchange gain. Exchange gain. Yeah. Then moving on, working number four, interest accrued 1040. Interest accrued 1050. Interest accrued. Here it is. Working number four, interest accrued. Done. We are done with this as well. Done. Then we have working number five. I hope all of you are following. Working number five, total tax expense. Total tax expense. So here we go. Working number five, total tax expense. Then let's go on. Working number six, nothing related to your P&L. So that means these were the only adjustments to be made. Yeah. And now how do you make these adjustments? How do you make these adjustments? What if I were you in your exam, I would cross-refer the cells to. How do you do that? I will press is equals to and a minus because, you know, some of these are expenses and that would give a negative sign. Is equals to minus, move my arrow keys, go to the relevant working and just, you know, once you reach that relevant working, press enter. Here you have it, 8,500 and that too with a negative sign. Yeah. Depreciation on plant and equipment is equals to minus. And here you have it, depreciation on plant and equipment of 31320. Again, you have it with a minus. Then you have an exchange gain. Here you have an exchange gain. I won't be putting up a minus sign. Make sense? So is equals to working number three, exchange gain. Just move your cursor. Come on. And here you have it an income of exchange gain of 2,000. Interest accrued is equals to minus. Move your arrow keys. Come on, guys. Move your arrow keys. Go on to interest accrued. And here you have it 1050. Yeah. And then you have total tax expense. Just move your arrow keys. Go on below. Total tax expense of 32,500. And here you have it. Yeah. So now you have all the expenses. Now I want to total it. If you want to total this number, I would rather prefer that you first put up a bottom border first, right? So that your examiner knows that you are going to total something here. And then you put up the formula is equal to sum to add, bracket open, and then select all the relevant cells that you want to add. An easier way of doing it. Rather than is equals to plus, 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 you can just sum it all at one go, bracket close. Once you have selected all the range, just bracket close. The total of adjustments, total adjustments are 71370 negative. So what should be our final profit after tax? What should be our final profit after tax? That should be 166,450 with an adjustment being made of 71370. So the total number should be 95080. Please, everybody confirm. Are you guys okay with this number? Do you understand this? 95080. If all of you understand this, just give me heads up. Okay. All good? All good? Okay. Done? Very good. Now we have requirement number B. We have requirement number B, which is to prepare a statement of changes in equity as at 31st of December 20x5. Yeah. So basically, this is our requirement. And how do we use to prepare statement of changes in equity? How do we use to prepare? You need to make column of all equity. Equity means ordinary share capital plus all reserves. How many columns do we need to prepare? Just start giving it up to me. You need to prepare a column for ordinary share capital. Yeah. We need to prepare a column for share premium. Yeah. Then we need to prepare a column for revaluation reserve in this question as well. Then we need to prepare a column for retained earnings. Now, these are the columns at least that I remember. Yeah. So there are no specific reserves here. There is nothing else here. So I believe this is the only thing that you need to have. Yeah. Here we have it. All good? And here you prepare a column for total. What do? We start with the opening balance. Acha, I'm not just going to show you the question, but if anyone of you can remind me what is the opening balance of for ordinary share capital and share premium. We just discussed this few minutes back. Very good. 100,000 and share premium of 0. Excellent. Very good. Acha, just let me know what is the opening balance for revaluation reserve. Full marks for that as well. I'm not going to show you anything. I'm not going to show you anything. Just let me know what's the opening balance of revaluation reserve. That is 02. Why? Why is that? Because before this year, the company did not revalue anything. Before this year, the company did not revalue anything. Yeah. So it's fairly obvious that it is 0 as well. Retained earnings, we can see it from the question. Opening retained earnings is 158,150. 158,150. Yeah. So once we have seen this, we'll go 158,150 with the total. Is equal to, just see what I'm doing, is equals to SUM sum, select all the cells, and there you have it, an opening balance total of 258,150. Done? All good? Then you start putting up transactions of during the year. Yeah. Now, during the year, we made a right issue, I remember. During the year, we revalued our assets, revaluation on land and buildings. Yeah. There was some excess depreciation too, if you remember it correctly. And what? And here we have it, defer tax on revaluation. Yeah. Defer tax on revaluation. Excellent. Moving on, moving on. Anything related to equity? Oh yes, one very important thing, which is profit for the year. We have these adjustments to be accounted for. So what is the value of right issue? Remember it was 25,000. Remember it was 25,000, yeah? So right issue 20,000 came to ordinary share capital. 5,000 came to ordinary share premium. Sorry, share premium. Yeah. So the total should be 25,000. Yeah. The total should be 25,000. Yeah. Then we had some revaluation on land and buildings during the year. Can anybody recall what was the revaluation done on land and buildings? Why recall? We have done it workings. Yeah. Just move your arrow keys, go on, and there you have it. The total revaluation that we did was 140,000. So this goes on to revaluation reserve. Just had to put this. Done. But some of the revaluation reserve, if you remember it correctly, was transferred to retained earnings. Some of the revaluation reserve was transferred to retained earnings. So basically the money was taken out of revaluation reserve and put into retained earnings. So if you want to take out money from revaluation reserve, you take a minus sign. Yeah. And how much was it? The excess depreciation. The excess depreciation, it was 5,500. 5,500. So you subtract something for revaluation reserve and rather add this in retained earnings. So what is the net effect? What is the net effect? Zero. It is just a reclassification of reserve, nothing else. And then there was some deferred tax on revaluation. So the deferred tax on revaluation, the accounting entry for that was deferred tax liability credit, and there was a debit. There was a decrease in revaluation reserve due to this deferred tax. So the money has to be taken out of tax from revaluation reserve as well, is equals to minus, go on to this 28,000 and just link it. Your examiner will exactly know where you are bringing this number from. Once you are done with it, the only last adjustment that you need to make is that you have earned some profit for the year, and that will go on to your retained earnings cumulatively. Yeah, to cumulate. And that is 95080, just linking it from above. Done. And now, as a result of this, you will have some closing balance. You will have some closing balance. I'll put up an underline here. Yeah. Now you have some closing balance, and how do you calculate this closing balance? Is equals to SUM sum. Just select all the cells. Just select all the cells. Even you can copy paste this formula everywhere, and here you have it. You have the closing balances. Please let me know if everybody is clear with this number. Everybody clear? Please let me know. Is everybody clear with this? Everybody. Not the usual faces. I want a confirmation from everybody. Excellent, guys. Excellent. Now, once you are done with this, you have the last thing to do. Last thing. And that is basically requirement number C. You have to prepare. Oh my God. You have to prepare, statement of financial position as at 31st of December X5. Oh. Yep. Now, when you prepare a balance sheet, you first put on the heading of assets, and under assets, you get non-current assets. If I remember it correctly, you had two types of non-current assets. One was land and buildings. Yeah. And the other one was plant and equipment. Correct? Now, if I were to ask you, what should be the value of your land and buildings? Can anybody tell me? Can anybody tell me? You see, your land had a revalued value of 80,000. Remember, we revalued this land by 30,000. So your land has a value of 80,000, or I can write just 80K. Yeah. Plus, you had a building revalued to 170,000. You had a building revalued to 170,000, but at the start of the year. So some revised depreciation was also subtracted from your assets value. So 170,000 minus 8,500. Yeah. Makes sense? So your land and buildings value will be, if you look at this clearly, 80,000 is equals to 80,000 plus 170,000 minus the depreciation for the year, which is 8,500. So now you have it 241,500. Is everybody clear in this 21,500 number? Please let me know. 241,500 number. Everybody clear in this? Very good. Now, what about plant and equipment? So plant and equipment, if you go back, your plant and equipment had a cost of 320,000. I'll just put it here. 320,000. Yeah. Your plant and equipment had a cost of 320,000. You can see it here. It already had an accumulated depreciation of 111,200. And then you also made some depreciation during the year of 31,320. Yeah. So technically, what should be your net book value to be reported in your financial statements? Those should be 177,480. 177,480. Understood? Done. And now is the turn for your current assets. What current assets do you have in this question? In my opinion, you have your inventory and you have your receivables. Yeah. So let us just go and check it out from your question. What inventories do you have? So the inventory, closing inventory was 115,000 and the closing receivables were 130,000. So 115,000 and 130,000. Done. Done. All good. Yeah. All good. So now once you have it, you can sum them all and have your total assets with you is equals to SUM sum and just total up your assets. Sum. Select everything. 663,980. I remember they didn't have any cash at bank. Just let me have a check again. Yeah, the bank was overdraft. I was correct. Yeah. So these are the only assets that they have. Correct. And now what we need to have is we need to have equity and liabilities. Right? So under equity and liabilities, first we will talk about equity. Yep. Under equity, we have ordinary share capital. Do you know how easy it is to prepare the heading of equity? Because you have already done it in the statement of changes in equity. Nothing unusual. So ordinary share capital we have. Then we have share premium. Then we have revaluation reserve. Then we have retained earnings. Correct? And we have already calculated the closing balances here. We can just is equals to and mark out these. Select these, enter, and these will be linked. Is equals to this. Is equals to this. Is equals to this. Here we have it. And our total equity would be is equals to sum, selecting all of it, enter. 490,230 as we prepared for it. And now comes the non-current liabilities. Under non-current liabilities, we only had two liabilities to be reported. One was 7% loan note. And the other one would be new for you. You might have not remembered it. It would be deferred taxation. Defer tax. Defer tax liability. Yeah. So 7% loan note. 7% loan note. What's the value of 7% loan note, by the way? It's 30,000. It's 30,000. So 30,000 is your loan note, whereas you created a defer tax liability in your books of accounts of 28,000. Here we go. I just selected it. Defer tax is always a non-current liability. Remember, fellows, defer tax is always a non-current liability. Done. Now here we have it. We have done non-current liabilities as well. And you can just sum these up. Total non-current liabilities are 58,000. Now we need to go on and, discuss current liabilities. Current liabilities. What do you have in your current liabilities? You have some trade payables. You have some interest accrued. I remember that. Yeah. You have some current tax payable. Yeah. And anything else, I don't remember. I don't remember. Yeah. Trade payables. I'll just write it down. Yeah. So trade payables. You had some trade payables of 70,500. You had some payables of 70,500. But there is something that you need to adjust. You have some trade payables of 70,500. Yeah. But do you guys remember that there was an exchange gain on your payables as well? Remember? There was an exchange gain on your payables as well, as a result of which 2,000 was reduced from your liability because the exchange rate moved in our favor. So you need to subtract this 2,000 as well. You need to subtract this 2,000 as well. So 70,500 minus 2,000 should be your trade payable, 68,500. Your interest accrued will be, my friends, 1050. Here we have it. We calculated it as the 6 months liability of our loan note. Then we have current tax payable. We have the current tax payable of 30,000, and that is also our liability. Good. If you sum all of these up, you have a total liability of 99,550, and hopefully we balance it in the first go. Total equity and liabilities. Total equity and liabilities. What's the total number, by the way? 490,000, 492.30 equity. Non-current liabilities 58,000 and current liabilities 99,550. And here we have it. We have a difference. What's the difference? Just get to know what's missing out. And I've got it what I am missing it out. Ali, you said it correctly. You said it correctly. Bank OD. Bank overdraft. I just did not see your comment. It was already there. 16,200, and there we have it. All good. All okay. Yeah. So do you guys, all of you guys, do you understand how this question has to be done? Are you guys clear in this? All okay? Just give me a thumbs up that all is okay. Perfect. Excellent. Now, luckily, we have just ended this question. We have just ended this question like nothing else. Yeah.